Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. A quick note, it's our third birthday. We started doing this in May of 2022. Founding host Mackenzie Babb and our chief economist Gerald Cohen fired this thing up. 3 years later, we are still here, and some of you are too. I know that some of you have been with us since the beginning. We thank you all. We thank everybody who gets up on Friday morning, the first Friday of every month with us. We appreciate it very much, and we're happy to keep doing it. We're going to keep doing it today, and we have a lot of things to cover. With us is the Institute's research economist, Sarah Dickerson. Topics can include, but may not be limited to, GDP growth, which was a headline this week, growth or lack thereof, consumer confidence and sentiment, which we've talked about the last couple of briefings. We will be back to talk about that again today. There will be many other things to talk about, so I'll let Sarah handle that part when she comes on in just a moment. She's going to speak for in the range of 15 to 20 minutes with her slides and presentation. After that, we're going to take questions from you all. You can ask questions at any time during the briefing by using the Q&A function at the bottom of the screen. If you're with the media, please let us know your organization when you ask your questions so that we'll know who you are and we'll make sure to move those questions to the front of the line. If anybody's joining us by phone today and you'd like to ask a question, you can do that. You can email it to me at rob_knan-flagler.unc.edu. I will keep an eye out for those. We'll try to fit in as many questions and as much stuff as we can in 30 minutes. We'll try to end it up about 9:30 or so. So that is all you need to know. From here, let me introduce the Institute's research economist, Sarah Dickerson. Sarah, good morning. Good to see you.
Good morning. Good to see you too. And thank you, Rob. So today we're going to be talking about a pretty healthy job report, but also falling consumer sentiment. And as our title states, some not so great consumer expectations, as well as some contracting GDP growth. We probably all want to know here, what does that mean for the economic outlook and the risk of a recession in 2025? So I will share my slides here. And just do this. Okay. All right, great. So like I said before, we are seeing fairly healthy job growth right now. So a fairly healthy job report. So we're seeing that this change in non-farm payrolls actually exceeded expectations. There was a downward revision for March, so that's worth pointing out. But like I said, in April, this is a pretty strong report. The same can be said for the change in manufacturing payrolls, exceeding expectations. Average hourly work or average hourly earnings looks pretty good as well. Average weekly hours actually ticked up a little bit. Unemployment held steady, and our labor force participation rate ticked up just a little bit as well. So what we are seeing here is a boost to job growth in April, like I just mentioned. And I'm sure a few people are wondering, well, what about some of the federal layoffs? At least that was the question that was on my mind. So we did see a bit of a decline in jobs at the federal level, but this was offset to a certain extent by jobs added at the state and local levels. And we are seeing wage growth as well. This continues to be above inflation. So this explained some of that healthy consumption and GDP growth that we saw last year in 2024. Although the GDP situation has changed a little bit in Q1 of this year, and I will get into that in just a moment. Okay, so then we have our unemployment rate. And what we're seeing here is that unemployment is remaining fairly low at 4.2%. So we did see this small uptick in March from 4.1% to 4.2%, but overall, I'd say this is pretty encouraging news that we have here. I don't know that we'll continue to see it for the rest of 2025, but again, we are seeing some of that resilience in the labor market. I also wanted to briefly discuss labor force participation, specifically looking at prime age workers. So for men, we see that they are at the pre-COVID levels, whereas for women, they're exceeding those pre-COVID levels of labor force participation. So why is that the case? I would argue that there are a few factors here. So first of all, flexible work arrangements. So we've seen the rise of hybrid and remote work that could be more appealing to women with young children, for instance. I also think that there's some necessity as well. So the cost of living has increased since pre-COVID times, and so households, at least some households, may be unable to get by on one income alone. So we're seeing that increase in the female labor force participation rate. Then we also have our labor force participation rate for those who are 55 and up. So we know that this fell during the pandemic, and it hasn't rebounded. So why is that the case? Again, I would say this comes down to a couple of different factors. I would say, first of all, some people in this age bracket may have the savings that they need, the assets that they need to live comfortably. So we know now that baby boomers purchased about 42% of homes in the housing market between 2023, 2024, during a time when a lot of younger generations are still struggling to break into the housing market. So they have a bit of an advantage in that area. I think there's also possibly a skills component here as well. We know that AI and tech are developing quite rapidly, and those who work in these fields need that kind of reskilling, upskilling to remain current. So it's possible that for someone in this age bracket who maybe has the means to live comfortably and wants to avoid that continuous skills acquisition, that this is the most reasonable choice to exit the labor force. Okay, so now shifting gears to the topic that's been on everyone's mind for the past couple of months, and that is tariffs. So we have seen the average tariff rate surge recently to levels we have not seen since the early 1900s. So why does this matter? Why should we even care? Well, tariffs are basically going to contribute to, or they can contribute to, higher prices for consumers and businesses, as well as some shifting trade patterns. Now, I should mention here that the administration has indicated that tariffs on goods imported from China should come down substantially. Also, the administration has stated that they want to offer some relief to specific sectors that have been impacted by tariffs, like helping automakers, for instance. But I did just want to reference this slide early on because the truth is that tariffs are at the heart of a lot of the economic trends that we are seeing this spring. Okay, and speaking of, so with tariffs, with some of the trade tensions that we've been observing, we are seeing the economic policy uncertainty index absolutely surge. So it was climbing for the past couple months, and now it is exceeding those COVID era levels that we saw. So the latest data from April shows it exceeding those COVID era levels. So again, why does this matter? Well, having uncertainty can have a broad range of impacts on the economy, delaying investments, slowing hiring, impacting consumer spending, for instance. But we also have our small business uncertainty index. And I think this is actually a really interesting indicator because small businesses tend to prefer the low tax, low regulation environment like the one we're currently in. So if they are expressing this high degree of uncertainty, it's somewhat telling and it's unexpected. So we did see in March that small business uncertainty declined, but it has remained elevated. So, what does this mean? I mean, it could mean that, for instance, small businesses are maybe adjusting to the changing trade policies. Maybe some of the recent comments from the administration on tariffs have offered some reassurance. But at the end of the day, this is one data point, and I think we need additional data before drawing any types of conclusions here. Okay, and then here is the slide that I think is especially compelling this month, and that is consumer sentiment and consumer confidence are both falling. So we'll start off with consumer sentiment. We see here that it's been falling for the past couple months, and it's reaching levels that we saw during the COVID days. So this makes it clear to me that consumers are worried. They're worried about how all of this uncertainty could impact their bank accounts and their job security. We also have our Conference Board Consumer Confidence, and we see here that again, this has been falling over the past couple of months, reaching levels that we saw in the earliest days of COVID. Now, consumer expectations has been falling. This has been falling since late last year, and it's driving some of that decline that we see in confidence, or that we see in consumer confidence. Now, I think one of the questions here is, could this signal a looming recession? I mean, if we look at the Conference Board's consumer expectations, so the line in orange, it's now fallen below the level that they typically use to indicate a looming recession. So does that mean it's imminent? The recession's imminent? I don't think that's necessarily the case. I think that we are more likely to see continued economic slowdown rather than a full-blown recession, but still an important indicator to watch and worth looking at as we move forward. Now, what does all of this mean for consumer spending? So consumer spending or personal consumption expenditures have fluctuated this year. So in January, we saw that there was a small decline in that consumer spending, whereas in February, it increased by a small amount, largely driven by goods. So this increase was likely, in retrospect, due to some pre-tariff spending. So we had consumers who rushed out to make their purchases before the price hikes occurred. In March, we also saw spending increase. Again, I think this is probably due to some pre-tariff spending, some of that preemptive buying behavior going on. And what does all of this mean for the personal savings rate? Well, we know that the personal savings rate has been low for a few years now. We saw it tick down slightly recently. I don't know that it will continue to remain this low. In the past, historically, what we've seen is that anytime we've had a period of high uncertainty, we might see households prefer to save rather than spend. So this is mostly because they're trying to be cautious about any potential economic downturn or potential job loss, for instance. And now the number that has probably been on everyone's mind since early Wednesday morning, and that is GDP growth. So we do see that GDP growth contracted by 0.3% in Q1 of this year. And I understand that this is concerning, but I still think it's too early to declare a recession at this stage. So typically, the recession is defined by 2 consecutive quarters of declining GDP growth. We did see that in early 2022, and we still avoided a recession. So what would I recommend here? I think at this stage, we have to wait and see what happens in Q2. Look at the data then, and at that stage, we can have a more holistic view of the economy and consider all of the economic factors that could potentially signal a recession. But at this stage, it's still too early to declare, and I will talk about that a bit more towards the end of the presentation. Okay, so now we have our short-term inflation expectations. And this can give us a good sense of where prices are headed. So what we see happening here, if we look at the University of Michigan's expected inflation rate, is that there was a surge in April to about 6.5%. So it's clear that consumers are expecting prices to increase sharply. Now, on the other hand, we are seeing that the 2-year inflation compensation rate is on the lower end. So this is basically telling us that investors anticipate moderate inflation in the near term. But what does this mean for headline CPI dynamics? So we've talked a little bit already about PCE, right? And that's the Fed's preferred measure of inflation. But if we look at CPI here, this slowed between February and March. And this was due, at least in part, to falling fuel and travel prices. Now, we do know that headline CPI contains energy, volatile energy, and food prices, so it can fluctuate sharply. So we also wanted to look at core inflation here as well. And interestingly enough, we see that core inflation has also declined. This may be due in part to slower rent growth and also the fact that we've seen some decline in prices for car insurance. So like I said, I recognize that PCE is the Fed's preferred measure of inflation, but CPI is important too. And right now, it's showing that inflation is cooling a little bit. Now, what does this mean for our recession risk this year in 2025? Well, I mean, truthfully, I have highlighted some values today that are a bit discouraging, right? So we're seeing this falling consumer sentiment, expectations, falling confidence. We're also seeing this contracting GDP growth. So with that in mind, I do think that the risk of a recession is higher than it was previously. Um, I think that it's higher than it was, but we're still more likely to see this gradual economic slowdown rather than a full-blown recession. And part of that is due to the fact that there are still some strengths in the economy. There's still some resilience. If we go back to what we were discussing about the jobs report early in the conversation, I mean, we are seeing employment rate hold pretty steady. We're seeing this boost to job growth, or we're seeing it exceed expectations. We're also seeing labor force participation looks pretty strong as well. On top of that, we just covered CPI, and that seems to indicate that, at least by that measure, inflation is cooling a bit. So, are we going to have a recession this year? Well, I do think that the likelihood is going to depend. Like I said, I think we're having an economic slowdown rather than a recession, but the likelihood depends on a couple of key factors. So first, tariff conditions. Like I mentioned, the administration has indicated that some tariffs will come down substantially, like for imports from China, for instance. They've tried to offer some reassurance to certain sectors, including manufacturers or automakers, for instance. So that's worth keeping in mind. But also, we need to consider how consumers and businesses are responding to the uncertainty, how they're responding to these changing trade policies. So we talked today about expectations and sentiment, but I think these are going to be some really important indicators to watch in the months ahead. Then finally, we have interest rate cuts. So right now, the Fed has indicated that they want more clarity before making any cuts. However, they've also received some pressure, especially from the manufacturing sector, to start cutting rates. So at the end of the day, I think that all of these elements are going to be important in determining whether or not we have a recession this year, potentially next year, and we'll have to continue monitoring them in the months ahead.
All right, very good. Thank you, Sarah. There was a lot to cover this morning. In fact, there was so much when I introduced you, I didn't even mention the employment report, which ostensibly is the reason we get up on Friday mornings for this. So sorry about that, but you covered it all good. And here we are 3 years later, and the Fed is always going to be one of the topics we talk about a lot here, I think. And it seems like they will have some interesting discussions ahead of them. All right, let's move on to questions and answers. Questions for Sarah, if you have them, please go ahead and submit them using the Q&A function at the bottom of your screen. If you're with one of our media outlets that's covering us, just give me your organization on there so I'll know to make sure to get that question in. You can also email me a question if you're with us by phone. You can email me at rob_knapp@Kenan-Flagler.unc.edu. Also, let me add, Sarah has written a couple of great pieces that you may have seen on our website about housing. So we didn't talk much about housing today, but if you have questions about housing, she's a great person to ask them. So pretty sure she'd be ready for those regardless. So let's see what we have. Andrew Jacobson asks, I think you said small business uncertainty declined in March, but that was before tariffs kicked in. Any sense of the April numbers for small business?
Yeah, I think that we have to likely wait and see what's happening there. I think that that's a really good point that he's made. You know, ultimately, it's like I said, this is a really tricky number to dissect because although I do find it to be especially interesting, and that's just because small business uncertainty is one of those factors that tells us, okay, well, how are those actors that are in the space that prefer the low tax, the low regulation, how are they actually responding to all of these changes, all of this uncertainty? So I think at least what I expect going forward, we're at least going to see continued elevated uncertainty among small businesses. Um, it's possible that it could climb, but I do think we will see that continued uncertainty, at least in this current environment, right? There's always the possibility of change. There's always the possibility that new information will become available, that will be provided by the administration. In which case, maybe the community will have that reassurance that they need, and uncertainty will no longer be a pressing issue there. But like I said, I do think it's not it's fairly likely that it will remain somewhat elevated.
Okay, great. Thanks. Um, we often get questions about what this report might mean to CEOs in the triangle, kind of based on the industry mix there and what they're looking at when they see this. What crosses your mind on that?
Yeah, so again, like I said, tariffs are kind of at the heart of a lot of the economic trends that we're seeing this spring. And I think for CEOs in the triangle, especially, um, it raises some concerns, right? So if you are um, working for or in charge of a company that is located in the triangle, you may be thinking about, do we need to delay expansions? Do we need layoffs potentially? Do we need to delay hirings? So I think, this has a potential to impact the labor force, the local labor force in this area. And that's just something for CEOs to be aware of. I mean, beyond that, I think it's kind of sector dependent. So for those who are in services, for those who are in retail, again, I think it's just important to keep in mind that we've seen this declining sentiment and declining confidence among consumers, and that could potentially impact business in the months ahead.
Okay. Here's another good one for you. Can you comment on whether the recent public company financial disclosures on most major companies are either reducing the year or pulling guidance? This compiled with the private equity data that shows funds are challenged. So are these early warning signs of accelerated decline starting in the third or fourth quarter?
Oh gosh, potentially. I mean, I think, yeah, I know that's not the answer that anyone wants to hear, but I think potentially. It's just, we've certainly seen a lot of fluctuations recently in everything. I mean, everything from the stock market to the yield. And I, yeah, I think that this continuation of uncertainty could, yes, potentially mean what you just described. But again, a lot of these responses that I'm going to have are data dependent. And I think at this stage, I'm kind of on the edge of my seat waiting for that additional data to come in.
Yes, uncertainty is sort of the word of the day every
I know,
day
and
for
I
the
feel
last
bad
few
about
months.
that, but
Well, we
I
get to play
just,
the uncertainty card too once in a while, I think. We're allowed that. So
yeah,
that's just the times we're in.
yeah.
Let's see. David Hill from the Triad Business Journal says, David Hill, do you see any meaningful implications in recent data for the housing market?
Sure. Yeah, I do. I mean, oh gosh, there's so much to unpack here, and you know that I could talk about this for a while. I mean, just to provide some context, I think that a lot of what we're seeing happening in the housing market is due to conditions that did not occur recently. So I think a lot of it has to do with the lock-in effect, with the slowdown in construction and supply chain constraints that we saw during the pandemic that kind of set the tone and created the current market that we're dealing with. Now, if we do talk a little bit more about recent data, I will say that this region is doing pretty well in terms of new builds. So our year-over-year growth in new builds, new construction is actually looking fairly strong. So while we are continuing to battle some supply issues in the housing market, and this is a country-wide issue, we're continuing to battle those supply issues, at least in this area. I think we're making more progress than some other regions in those new builds. I would say, beyond that, I mean, it's a little bit difficult to say at this stage because we're anticipating some rate cuts. But the Fed has made it clear that we are waiting for more clarity before we make any concrete decisions or let you know what our plan is. So sure, could rates come down a little bit? I think that's possible, but I also think that we have some people waiting on the sidelines to purchase homes, and they may continue to do so because I don't see us returning to some of those record low mortgage rates that we saw in 2021, for instance.
Okay, very good. Let's see. Max Tendler from North Carolina Public Radio, WNC, asks, aside from the second quarter of GDP decline, what economic fluctuations are you on the lookout for as indicators we've entered a recession?
Yeah, I mean, I think that's a good question. So I'm going to say at this stage, and I kind of alluded to this during the presentation, that looking at GDP growth alone probably isn't sufficient in light of some recent events and the fact that we saw those two consecutive quarters of declining GDP growth in early 2022. So beyond that, I mean, I think we're all very carefully watching what's happening with inflation, absolutely watching what's happening with inflation, and how the Fed is responding to that. I also, this was a very healthy jobs report and very encouraging in many ways. But, when we do this deeper dive into expectations, sentiment, and all these other aspects of the economy, I mean, it does make you wonder if, this is kind of the calm before the storm, and if we could see more weakness in the year ahead in our labor market. So yeah, I'm watching a lot of different economic indicators because I think that these are uncertain times, and to have the clarity that we're looking for, we need to consider those broad range of factors and monitor them closely in the months ahead.
Okay, very good. That looks like this is the end of our search for clarity for this month at least. We've reached 9:30. So thank you to Sarah Dickerson for the presentation and for answering questions today. We appreciate it very much. And we know these are kind of hard times to answer questions in sometimes because there
Just
are a
a
lot
little
of
bit.
variables at work. Yeah. So we appreciate the effort. It means a lot. Thanks also to all our attendees. Thank you for your questions. We always appreciate those and they help drive the show. For our media members out there, if you'd like to connect with Sarah or any of the rest of our experts, please reach out to me. Be happy to connect you. We can continue the conversation. I'm at rob_knapp at kenan-flagler.unc.edu. For everybody out there, we hope you'll visit our website, kenaninstitute.unc.edu. There is plenty for you to read there. You might also check out our collaboration with Fifth Third Bank, which is at empoweringamericancities.com. If you've been following our Mythbusters series on manufacturing, we have a fresh one up there for you to look at. So plenty of things going on in the economy, plenty of things going on the website, lots to attend to. Um, I think that's everything. We hope to see you again in June. I believe it's June 6th. Check me on that, but I think it's June 6th is the Friday. So anyway, again, thanks for being with us. We appreciate it very much. Hope to see you next month and enjoy the rest of your Friday.